I'm Ashton Addison from Blockwest Capital for Investment Pitch Media, and today on the Crypto Coin Show we have Darshan Vaidya, the CEO and co-founder of Credora. Darshan, welcome to the show, and thank you for taking the time.
Thanks, Ashton. Thanks for having me.
You're very welcome. I'd love to dive into credit on the blockchain and in DeFi. How do we build credit limits in a way that especially for people that didn't have access to banking institutions or underbanked, unbanked, can start to build credit in the future of finance. I'm excited to dive into what Credora is working on there. Would love to start off our conversation by just hearing a little bit from a high level on what your team has built out so far at Credora, and then we'll dive into all the details.
Yeah, so our philosophy here at Credora is to make credit risk more transparent and facilitate credit more easily through making credit risk more transparent. So what we essentially leverage is privacy-preserving architecture, where we can consume real-time data about a borrower and the risk that is associated with that borrower, but without having to see any underlying data. And so we can stream that in real time and can then produce these privacy-preserving factors that borrowers are more comfortable sharing in real time, that lenders can then use to better manage the risk, which obviously we're seeing over the last few months, and especially this week is super pertinent. So I guess comparing it to the traditional underwriting process, especially for businesses, is generally you have some neutral arbitrator that is trusted with all the data and then produces like scores. Or if you're underwriting a business, you tend to have like static data, usually financial statements, etc., where you have monthly or quarterly updates, and they're like in the form of like a PDF or audited financials essentially. And obviously that has a lot of value, but the problem is that they're stale, and in markets that move very quickly, those cannot mean a lot, like when it comes to actually assessing someone's risk day by day. And so this real-time data allows a lender to know how that borrower is performing when markets have changed, like over the last few days, and also allows you to get a more granular understanding of where that risk is. And allows you to do it in a way where you don't have to trust a particular intermediary to make that assessment. You can essentially access the factors yourself and then make an assessment yourself on what that risk is. So yeah, broadly what we're doing is trying to improve the way underwriting is done, and essentially we're focused on institutional credit, but think that it can open up a variety of different sectors of credit.
That's incredible, and I always laugh when people talk about these quarterly reports, and I feel like it's becoming more and more antiquated, where there could be a multi-$100 million fund, and people want to know how their investment's doing, and they say, well, check back in 3 months on our piece of paper quarterly report, and it's like, well, I sort of want to know now. A lot happens in crypto in a week, never mind 3 months, and I feel like more and more this is becoming a necessity to have this real-time information. And you mentioned their institutions. I've seen a lot of sort of building credit for the underbanked, but also it's important for the big money in blockchain as well. Are you catering this technology to sort of investments at all levels?
So yeah, basically we do focus mostly on institutional investors at the moment, because that's where the most demand is, and the data that we can collect is most representative of their creditworthiness. So where we started our business is in the crypto native borrowers, where it was very difficult to access capital, and yet there was a lot of data that was private, that was available, that was accurately reflecting their creditworthiness. So we started with that sector of borrowers, but really like the data that we can compute on is anything with an API. So if it's a small business like a fintech, for example, we could plug into their real-time bank accounts, we could plug into their like SaaS APIs, and we can compute all of that in a provably private way. So we have infrastructure that that is making these credit computations, but in a way where the ultimate borrower doesn't have to reveal any information to anyone. So reveal any sensitive information to anyone. And so, yeah, can we do this for non-institutions? For sure. Like, I think that there are lots of sectors of credit that are underserved in terms of people that struggle to prove their creditworthiness because they're in a certain geography, or like there is other factors that limit their ability to access credit. And this just opens it up in a way where, okay, if I can prove myself to be creditworthy using this data source or that data source, then you can, in a very real-time way and programmatically neutral way, you can attest to your creditworthiness.
Good to know. And looking at the recent events this week, specifically with the FTX.com insolvency, and the amount of funds, billions and billions of dollars that they had, and their Alameda research arm, and receiving money, borrowing, and lending out to different people, apparently not having 100% reserves. Obviously, there's an issue with the creditworthiness of this. I guess they were making risky bets, and maybe they lost a lot of money, and now all of the users of the cryptocurrency exchange don't have their funds. Does this technology that Credora is building sort of improve upon the process in which an issue like this could have been solved, or how do you see sort of the creditworthiness of these huge institutions like FTX that are supposedly multi-billion-dollar empires all of a sudden crumbling?
Yeah, I mean, obviously, it's a terrible situation that's happening at the moment, I think, for the industry as a whole. And so I don't know if I'm qualified to comment specifically on them, but I think what we're essentially advocating for is better transparency of this borrower and essentially the balance sheet that they're representing to be able to access credit. So on the asset side, as a lender, if you are lending to someone based on their representation of a balance sheet, what you can do is ask them to validate it using our technology. So you can, in real time, validate X percentage of the assets, and so that you're attesting to on a balance sheet. So you can plug in real-time accounts and in a provably neutral and private way, verify that, okay, I can validate that my assets are at least X amount or X percentage of that balance sheet amount. There may be some assets that are intangible that are hard to quantify, but you can at least validate this amount of liquid assets. And this is the risk associated with those assets. And it allows us to get a much more complete picture of that asset side. On the liability side, you can essentially mandate that lenders enter their loans to this particular borrower in some encrypted database that allows, again, to be able to validate someone's overall leverage across like all the different lenders that they operate with. Now, what it can do then is do a few things. Is if the borrower does not plug in enough real-time data to validate their balance sheet, it might ask you to think twice about how much you lend to that particular borrower. If they do plug in their accounts and there is a lot of risk associated with those assets, which it would again flag, you would again look to maybe lend them less or not lend to them at all. If something changes in their risk, it was actually quite low risk, but then something drastic happened and those assets declined in value substantially, you could see that too, and you could call back the loans much more effectively and quickly and make sure that they don't borrow more. And so, yeah, we strongly believe that the answer to a lot of this credit climate is moving away from a relationship-focused, trust-based lending world to an environment which is more focused on data, and a lending market that is data-driven, transparent in terms of the risk, and much more competitive and fair. And so, yeah, that's definitely a relevant factor in like how we built the business. And for situations like this, we don't want to see them happen, but we do think we provide like a practical solution to situations like it.
Definitely, great points. And with that specific situation, from what I understood, a lot of the, sort of with FTX, they had this FTT token, which undiluted, had an $8 billion market cap, but it seems like it really didn't have that much liquidity. To say that you have all these funds that you could potentially pay back a loan, but really looking into the assets that they own aren't really as liquid as you think that they are. Is that something that Credora's technology can look into in terms of looking at assets on how they could pay back, and could those actually be liquidated to pay back a loan?
Yeah, so essentially our technology is able to basically produce risk factors associated with the assets it plugs into. So if it was to plug into assets that are like stablecoin or Bitcoin or just fiat in a bank account, it would give it a risk score that was appropriate relative to its both directional exposure but also its liquidity. And similarly, if it was an asset that was super illiquid, it would give it a poor score, relatively speaking. So yeah, I think the power of the privacy preserving technology is you can basically generalize someone's private information into something that's useful for a lending decision. I'd say the problem today is that people don't want you to plug into their ultimate positions, and so they supply these like monthly financials, and the things that you might want to plug into are proprietary and sensitive. So how can you bridge that gap? Is you can use privacy preserving infrastructure to validate the things on that real-time information, but without having to actually see it. And so you don't have to wait for the next financial statement to see that actually those assets are now like half as much or 90%, whatever it is. And so, yeah, if you look at like, you mentioned financials earlier and like this kind of archaic way of doing things. And I do think that financial statements provide context and they're important, but it's kind of like we have all of this data that if you knew, like let's say if you were watching a sports event and you could see the score at like the start of the game and then at the end of the first quarter and then half time and then third and fourth quarter, whatever it may be. Like I'm British, so I might be getting the vernacular wrong, but like basically if you had some way of having a proxy in between those snapshots, you would definitely capture that if you were actually betting on the game or had some sort of interest on how that game went. And so whether that was like watching it on TV in real time or whether it was some proxy of that, like listening to it on the radio or some text commentary, whatever it is, it adds value to be able to connect the dots between this static financial statement and then the next financial statement. And so this data basically allows you to really extrapolate very accurately someone's creditworthiness changing in real time.
Great point. And Darshan, I saw that Credora is working alongside Maple Finance, who we've had on the show, with the Solana pool that they have. Can you talk about how that works and how Credora is involved and sort of the creditworthiness, transparency of the pool and how your team is helping with that?
Yeah, so essentially what we do is we provide more transparency of a particular loan and a borrower to any lender. What Maple and many of the DeFi projects that are focused on credit are doing is making that loan book more transparent. Like essentially who has this lender lent to. So if you had like a BlockFi or a Genesis or some of these large firms that are lending, you don't often know where they've actually lent. You have some idea of who their most large borrowers might be, but generally you trust them and they are your principal risk. You're essentially trusting them to allocate the loans according to their own risk processes. Essentially, like on-chain lending protocols make that process more transparent. They have to tell you exactly who's borrowed and at what rate, and allows you to make a much more informed decision on that. And so Maple is obviously doing a great job of that, and we work with various DeFi protocols that give you that optionality. What we do is give you the ability to quantify the risk of each of those loans. So you can see that I've made these 10 loans and the risk associated with that is X, and it is changing in real time. And so it gives you a lot more transparency. What we do with Maple specifically on Solana is, based on the scores and the factors that we have in real time, we construct the portfolio of loans that pool makes, decides to lend out. And so it's able to, in a data-driven way, allocate loans and based on the creditworthiness of the borrower, and also monitor those loans in real time as they're out there, and give lenders real-time data about those loans while they're out there. And if any of those risk factors change, we can also pull back those loans immediately, which we've been able to do recently.
That's good to know. And with Solana specifically, I recently saw some FUD on Twitter about, because there was, I don't know how deep the ties are, but to the FTX ecosystem, Solana ecosystem sort of tied in, and there was news about a lot of people unlocking their Solana and short positions opening and the price going down. And if you're taking loans in those assets, then there could be a lot of sort of margin calls. I don't know if that really ties into the personal creditworthiness, but it definitely ties into sort of the liquidity or the volatility of these assets. Is that something that Credora was monitoring? And because I know Solana dropped a little bit recently here.
Yeah, so when it comes to assessing the creditworthiness of borrowers, or generally where we provide our services, we're chain agnostic, asset agnostic, off-chain or on-chain agnostic. So we're able to grab data from everywhere. And so essentially, yes, when the prices of all these assets changed, we were able to see in real time, and as a result, immediately update the creditworthiness metrics that we have on a borrower. With regards to our pool specifically, it's a USDC pool, so it doesn't have any of the wrapped assets or any it isn't affected by any of those factors that you were alluding to earlier. It's just completely detached, I guess, from that.
Very cool. Good to know. And yeah, it's great to have all these stable coins, and these, if you're taking out loans, obviously the riskier assets are a lot riskier, especially with if Bitcoin moves a little bit, all of these other smaller cap assets move a lot more volatile. So good to know about that. And now we don't have a lot of time left, Darshan, but I'm curious on what's in the future for Credora, and sort of what are the main initiatives your team is working on moving into 2023.
Yeah, so really what we're looking to do is grow our adoption in terms of trying to make the space more transparent in terms of the credit risk and risk associated with the yield it's offering investors. So we obviously have seen a lot of DeFi projects over the last 12 to 24 months, a lot of yield opportunities, but I think the focus on where that yield is coming from has been limited. And really our goal is to make, whenever that risk is credit, we want to make that credit risk more transparent and explain that yield more easily. And the kind of borrowers that we want to encapsulate are going to be broader. So over the next 12 months, we'll focus on not just crypto native institutions, but we'll focus on just regular fintechs. We'll focus on other types of borrowers where we can better facilitate credit and improve access to capital. So yeah, we're looking to keep growing our business and keep creating a better standard for credit in this market, which we think is desperate in need of those standards. So we're optimistic that while this is a really tough time for the market generally, I do think that we'll come out of it with a much better and stronger approach towards credit risk. And what we want to do is just provide the tools to let you do that. We're a little bit, I think people are a little bit tired of hearing that, well, you never know. And it's like, well, you can, right? Like, you can know a lot more than you know right now. You just need to force some transparency on both the lenders and the borrowers. And so, I think events are transpiring that should allow us to do that.
Great insights, and thank you so much for taking the time, Darshan. I will leave the links to Credora's platform and the socials as well in the description box below for the viewers to follow along. I'm looking forward to your team's growth in 2023 and making DeFi and lending a safer space. So thank you for the work that you and your team are doing, and let's definitely follow up in the near future.
Thanks so much, Ashton. Pleasure to be on the show.